As an economy grows, it generates money. And at one point, the economy generates so much money, the economy simply cannot consume it at the time. And when there's a surplus of money being invested in assets such as homes, stocks, or bonds, prices rise and interest rates fall. Eventually this bubble grows and the prices reach irrational levels and then they collapse. Once it collapses, money becomes scarce and inefficient businesses are forced to shut down. Efficient businesses survive and the cycle starts over. The cycle has been repeating since the adoption of modern capitalism. Now sometimes a state interferes with the cycle by keeping money cheap in order to avoid the crash and the recession that follows the crash. For a government, money is an instrument to cool down the bubble. The Federal Reserve Bank can print as much money as they want, and it can purchase government debt with it. That's what the Federal Reserve did in the aftermath of September 11. The Bush administration did not want to raise taxes to finance the war in Iraq, and the Federal Reserve cooperated by financing the war. This was essentially done by lending money to the American state. The result was that the American people didn't feel the direct economic burden of the Iraqi war. Now the Bush administration simply wanted to avoid domestic problems. After all, lowering tax rates during wartime is a classic tactic to keep positive public approval for the war. And President Bush simply wanted to win his second election. Therefore, he took this approach. The Bush administration wanted to increase the total revenue of taxes by stimulating the economy. Now, the idea was that the combination of military spending, tax cuts, and low interest rates would allow the economy to surge. This is how the Bush administration intended to finance the war. Of course, this was only a short-term solution, and it would have worked if the war lasted only 2 years. And this really is the biggest mistake the Bush administration made. They underestimated the war in Iraq. After being double-crossed by Iran, the American war in Iraq became much longer and much more intensive than originally anticipated, and the American economy simply wasn't prepared for a long, intensive war. As a result, the Bush administration and the Federal Reserve were never able to cool down the economy. Now, while the Federal Reserve was producing cheap money, an extraordinary amount of this money poured into the residential housing market. This money flew into the economy and it allowed more people to buy houses. There were even millions of low-income buyers who in ordinary times never would have qualified for the mortgages they took on. There were also government programs that encouraged individuals to buy homes. Now, housing prices tend to rise over time, which gives real estate the appearance of a reliable investment. So at the time, it seemed like a good idea to take on a mortgage, because the prices of homes had risen for the past generation. But the underlying truth is that the prices of houses increases very little. What really increases is inflation. So you can see how this all fits together. It was cheap money produced by the Federal Reserve that financed this all, and producing cheap money increases inflation, which in turn increases the housing prices and gives this the illusion that property value is increasing. But in reality, what is happening is the devaluation of the dollar. So if you actually adjust home prices for inflation, they have increased very little in the past 30 years. But the thing is, mortgages don't rise with inflation. So, for example, if you borrowed $20,000 to buy a $25,000 house in 1970, then by the year 2000, that house would be worth about $125,000. And you would have paid off your mortgage. And this seems like a good investment, but it is an illusion. The $125,000 is worth about $25,000 in real terms. The remaining $100,000 is inflation. So you may feel richer because the numbers are higher and because you have paid off your mortgage, but in reality, you have made minimal gains in the past 30 years. Now let's go back to the cheap money that was being produced by the Federal Reserve. As I said, this money went straight into the economy, particularly the residential housing market, and the demand for houses rose. As a consequence, housing prices took off like a rocket in 2001. Thanks to the inflation, prices further accelerated in 2004. More and more people took on mortgages based on cheap currency. The lenders made their money mostly by closing costs and other transaction fees. The lenders then sold the mortgages as bundles to secondary investors. For the secondary investors, buying the mortgages seemed like a reliable stream of income. And for a while it seemed like everyone was making money and nobody was really at risk. But in reality, the cheap money and debt was being passed on like a contagious flu. Now, many American investment banks had actually sold their bundles to banks in other countries. And this is how American debt spread around the world and became a real international financial crisis. It's easy to get caught up in the moment. European banks were selling and buying American mortgages as bundles, and all the while all of this was based on cheap money with no value whatsoever. The new low-income house owners were the first to default. While people expected house prices to continue to grow, their expectations could not be more wrong. When the decline started, it was already too late to make a profit, and investors rushed in and sold their houses at whatever price they could to minimize their loss. This steady decline started in 2005, and by 2007 the panic kicked in and house prices were crashing down. But in truth, the house prices returned to their normal rates. The secondary investors who had invested in these houses were devastated. The flu was now mutating into a deadly virus, because the mortgage bundles had no value whatsoever. That's why investment banks like Lehman Brothers and Bear Stearns went bankrupt, because when the loan payments were due, these banks could not cover their bets. And so when American banks sneezed, the international financial system got the flu, and the damage was truly worldwide. Anyway, this was a Caspian report by me, Shirvan. Thank you for watching. Sahol.